Charlie Munger is a legendary investor and businessman known for his wise investment decisions and his insights on human behavior. One of Munger's key areas of focus is on the impact of cognitive biases on investment decisions. Munger believes that understanding and avoiding these biases is essential to making successful investments in the stock market. So in this video, we'll be sharing with you the top 5 cognitive biases that Munger believes every investor needs to be aware of. The first cognitive bias that Munger highlights is confirmation bias. This is a common tendency among investors to seek out information that confirms what they already believe to be true and ignore information that challenges those beliefs. While it's natural to want to validate our own beliefs and opinions, this bias can be particularly dangerous when it comes to investing. One of the most challenging aspects of confirmation bias is that it can be difficult to recognize in ourselves. We may not even be aware of the ways in which we are selectively seeking out information that supports our existing beliefs. An example of confirmation bias in action is a stock investor who has a strong belief in the long-term growth potential of a particular company. Despite mounting evidence that the company is facing significant financial challenges, the investor continues to hold on to the stock and ignores any negative news or indicators that suggest the company may not be performing well. In this case, the investor is selectively seeking out information that supports their belief in the company's growth potential while ignoring any evidence of the contrary. By failing to consider all available information, the investor is putting themselves at risk of making poor investment decisions based on flawed assumptions. Munger's advice to actively seeking out this confirming evidence can help investors avoid this type of confirmation bias. He argues that seeking out this confirming evidence is an essential part of making sound investment decisions. By considering multiple perspectives and being willing to change our minds in light of new evidence, we can avoid the pitfalls of confirmation bias and make more informed investment decisions. The second cognitive bias that Munger emphasizes is overcompensation bias. This bias occurs when we overcompensate for mistakes we have made in the past by making overly cautious or aggressive decisions in the present. Munger believes that investors should be careful not to overcompensate for past mistakes, but rather focus on learning from them and making better decisions in the future. One example of overcompensation bias in investing is when an investor experiences a significant loss in a particular stock or market and become overly cautious as a result. They may become hesitant to invest in similar stocks or markets in the future, even if there's a potential for a positive return. Alternatively, they may become overly aggressive and take on too much risk in an effort to make up for past losses. Munger advises investors to avoid overcompensating for past mistakes by focusing on the future and making better decisions based on what they have learned. This means taking a long-term perspective and not letting past mistakes dictate current investment decisions. By focusing on the present and the future, investors can avoid the dangers of overcompensation bias and make informed and strategic investment decisions. The third cognitive bias that Munger highlights is known as the sunk cost fallacy. This is a common pitfall among investors who continue to pour money into a losing investment simply because they are already invested so much time and money into it. This is a classic case of throwing good money after the bad, and it can be a hard bias to overcome. Munger advises investors to focus on the future rather than the past and not to let sunk costs influence their investment decisions. Instead, investors should carefully evaluate the potential return on investment for any given opportunity and make decisions based on future potential rather than past investments. An example of the sunk cost fallacy in action is a stock investor who purchases shares of a company that experiences a significant decline in value shortly after the purchase. Rather than cutting their losses and selling the stock, the investor holds on to it, hoping that the stock will eventually rebound and recoup their losses. This may be driven in part by the desire to avoid acknowledging a mistake or loss, but ultimately it's a poor investment decision that could lead to further losses. Munger's advice to focus on the future potential of an investment rather than the past investment can help investors avoid the sunk cost fallacy and make more informed decisions. By being willing to cut their losses and move on from a poor investment, investors can minimize their losses and maximize their potential returns. The fourth cognitive bias is social proof bias. This is a tendency to rely too heavily on what others are doing and follow the crowd, rather than making our own independent investment decisions. This bias can be particularly strong when we see others succeeding in particular investments, as we may feel pressure to follow suit and not miss out on potential profits. An example of social proof bias in action is the stock market bubble of the late 1990s. At that time, many investors were buying up tech stocks simply because they saw others doing the same and didn't want to miss out on potential profits. However, this led to a bubble that eventually bursts and causing many investors to lose significant amounts of money. Munger warns that blindly following the herd can lead to poor investment decisions. Instead, he advises investors to do their own research and to think for themselves. By taking the time to evaluate investments based on their own merits and not simply following the opinions of others, investors can make more informed decisions and avoid the pitfalls of social proof bias. The fifth and final cognitive bias that Munger emphasizes is the incentive cost bias, which can be a major obstacle for investors. This bias arises when our incentives are misaligned with our investment goals, leading to misguided decision making. For instance, let's say an investor has a financial advisor who earns a commission on certain investment products. The advisor may be incentivized to recommend those products to the investor, even if they do not align with his or her specific financial goals or risk tolerance. This bias could ultimately harm the investor's portfolio performance and financial future. Munger firmly believes that investors must always be aware of their incentives and ensure they are aligned with their investment objectives. By doing so, investors can steer clear of incentives that may compromise their best interests and make well-informed investment decisions. Therefore, it's essential for investors to do their research, seek out unbiased advice, and consider their long-term financial goals before making any investment decisions. In conclusion, these 5 cognitive biases can be major stumbling blocks for investors. However, by understanding and actively seeking out to avoid them, investors can make more informed decisions and increase their chances of success in the market. Munger's emphasis on independent thinking, openness to challenging beliefs, focus on the future, awareness of incentives, and learning from past mistakes can help investors avoid these biases and make sound investment decisions. It's important to note, however, that how investors go about avoiding these biases is subjective and can vary from person to person. Munger's advice serves as a helpful framework, but ultimately, each individual must find their own way to overcome them. To learn more about how you can secure your financial future, check out the next video popping up on your screen right now.